Hello everyone and welcome back to our channel. In today's video, we're going to simplify GASB Statement number 87. So let's dive in. GASB 87 aims to improve lease accounting and financial reporting for governments. It requires governments to recognize certain lease assets and liabilities that were previously treated differently based on payment provisions. The key points are as follows. A lease is a contract that allows a government to control the right to use another entity's non-financial asset, like buildings, land, vehicles, or equipment, for a specific period through an exchange or exchange-like transaction. The lease term includes the non-cancelable period, plus certain optional periods if likely to be exercised. The term is affected by options to extend or terminate the lease. Short-term leases have a maximum term of 12 months or less, and they're recognized based on payment provisions without the need for lease assets or liabilities. A lessee recognizes a lease liability and a lease asset at the start of the lease term. The liability is the present value of lease payments, and the asset is initially measured at the same amount. The asset is amortized over the shorter of the lease term or the asset's useful life. A lessor recognizes a lease receivable and a deferred inflow of resources at the lease's commencement. The receivable is the present value of lease payments, and the deferred inflow is the same amount. The lessor recognizes interest revenue and inflow of resources over the lease term. Lease and non-lease components are accounted for separately. If it's challenging to allocate the contract price to components, they can be treated as a single lease unit. Amendments to lease contracts are considered lease modifications. Terminations are accounted for by adjusting lease liabilities and assets. Subleases are separate from the original lease. Sale-leaseback accounting applies only if a sale is involved. Otherwise, it's considered a borrowing. Let's take a look at an example. Consider the fictional city of Oakville that owns a historic building used as City Hall. The city has decided to lease out a portion of this building to a local art gallery for a period of 10 years. The annual lease payments are $20,000, and the gallery also agrees to cover all the maintenance costs associated with their leased space. According to GASB 87, the city of Oakville needs to classify the lease as an operating lease. Here's how the lessor accounting would work. At the start of the lease, the city of Oakville would recognize a lease receivable for the present value of the future lease payments. Let's assume that, based on the terms, the present value is calculated to be $180,000 each year. The city would recognize interest income on the lease receivable and reduce the lease receivable as the lease payments are received. The interest income is calculated using the effective interest rate method. The city will recognize the portion of lease income received as interest income, reflecting the time value of money, and the remaining portion will be considered a reduction of the lease receivable. For the local art gallery, as the lessee, they would have the following accounting entries. At the start of the lease, the art gallery would recognize a lease liability for the present value of the future lease payments. Let's assume the present value is $180,000. The gallery would also recognize a corresponding right-of-use asset for the same amount. The art gallery would amortize the lease liability over the lease term using the effective interest method. Each year, the interest expense would decrease as the liability is paid off. Additionally, the right-of-use asset would be depreciated over the lease term, aligning with the reduction in the liability. Lease payments. When making lease payments, a portion of each payment would be allocated to reducing the lease liability, while the remaining portion would be recognized as interest expense. This distinction is crucial because the total lease expense isn't equal to the cash payment. It's divided between reducing the liability and recognizing the interest expense. Overall, GASB 87 establishes a single lease accounting model, enhancing the relevance and consistency of financial information about government's leasing activities. Thanks for watching.